Now we're going to shift to the US and look at GDP. So again, we're not going to go over this. We're just more of a recap because we've discussed it before. And obviously this is a bit older, but we want to talk about where we are right now, where we think we're going to go. And here you can see that GDP fell in Q1 by 1.4%. And well, I should say negative 1.4%. Consumer spending was still fairly strong, but you're getting the durables, non-durables. Again, services is going to be the driver. And we want to look at price and cost because that's going to be a bigger hindrance. And we're starting to see some of the cracks show up when we'll talk about the small business numbers and what they're seeing on the corporate side. Then when you look at non-residential investment, the equipment IP continues to be strong. You have companies that are looking to obviously replace. And this is, again, you're seeing that investment in flexible schedules, work from home where you're investing in equipment, IP, but you're not investing in structures. And then when you look at residential, obviously that continues to be a big thing. But the biggest shift in what drove that miss or that negative growth was imports. So imports had a huge spike, exports had a drop, but that's going to adjust a bit back to the Chinese issues that we talked about in segment 1. A lot of these shortfalls. So we will see imports drop, and that'll help kind of buffer some of this number as government spending or that fiscal drag continues as they roll back a lot of their stimulus and it continues to expire, creating some of that drag. And the reason why we want to talk so much about the consumer is because the percentage of real GDP, almost 71% is generated by the consumer. So the consumer is the one to watch. They're the ones, but when you look at the growth in general, you're starting to see where, we had this nice little peak in Q1, and now we see a fairly steady drop off as prices bite. And you've seen people go from essentially spending out of savings to going back to credit. But now credit usage is above where it was pre-COVID. So we've had that snapback. Now as that's coming back, that's where we start to see a bigger drop off in spending. Government spending continues to slow. That's not going to stop. Fixed investment, we think, is going to be fairly stable while the import-export will improve. And as the net exports-imports improve, that will help give us, and that's why we do think that we'll get some growth in Q2. It's Q3 and Q4, more specifically Q3, that we think there's going to be a much bigger problem. And when you look at the contribution to real GDP, you can see, again, the drag was that net exports. That was where we had the drag, and we had it in inventories. If you remember last year, or in the beginning of this year about Q4 of 2021, we said that inventories are lumpy. And based on all of the leading indicators, we expected to see a big spike in inventories, and that's what we got. Now as inventories build back up, you have companies going, well, now that I have the inventory, I'm going to slow down my new orders. I'm going to slow down my new purchases because I'm just going to work off of the inventory at this point. And that's what we've seen. That's what we've been highlighting, and it's starting to come to fruition. But when you look at imports, that will slow, which will improve some of that import-export. We're still a net importing nation. It won't go positive, but it just won't be as negative. And that'll be a benefit in general. But the inventory problem is the one, again, that created that lumpiness in Q1 of Q4 of 21. And then you had a little bit of a drag on Q1 of 2022. And we don't expect too much of a movement here because inventories continue to build, but not at the same pace that we saw in Q4. So it'll be a positive contribution, but not to the same way that we saw on the last year. And that's when you start looking at EPS, you look at S&P 500 and you look at where those models are going. And this is where when you start looking at margin, because costs are going up, wages are going up, factory gate prices are going up, and how much of that can be passed through is eating into margin, which we think is going to put more pressure. And I think this chart does a good job of showing where some of that slowdown is going to originate from. And that's all creating a lot of this economic sentiment shift when you look at people, the way that they're viewing the market, new homes, again, lowest it's been, major purchases remain slow, U.S. economy, the view that the economy is getting better is worsening, and personal finances, people are getting more and more concerned about personal finances, which is why when we look at Americans' financial worries. Well, and the reason why we talk about this is because if you're concerned about your financial situation, you're going to try to limit spending. And if you limit spending, then what happens next? So when you start looking at bills, maintaining the standard, the standard of living you enjoy, 52% say that they're worried. So over half of the people that were interviewed are saying that they're concerned that they're going to have to change their living standards and drop back down. 35% are concerned about paying the rent or mortgage, and that's a bigger problem because prices are going back up. Credit cards are showing up again. Again, people are borrowing from credit, and we're starting to get back to that level, and that's what we have some charts actually showing how quickly we've gotten there. And that's where we continue to see pressure across the board, which is, again, showing up in a different way where Americans' rating of their personal financial situation, you can see that 38% only fair, 46% say good to excellent, down from over almost 57%. And a lot of that is showing up between only fair and actually poor. So annual economy and personal finance poll shows 46% of U.S. adults rate their financial situation as excellent, lowest since 2015. 16% say their situation is poor, highest since 2016. And we see that continuing to deteriorate as real disposable personal income per capita is now negative. It's still above pre-COVID, but you can see it's moving in the wrong direction, which is pulling more money out of personal disposable savings. Because you can't save what you don't have, because you're taking that extra money and you're putting it into your goods to try to maintain your semblance of what you've gotten comfortable with, or you've tried to keep, which is why savings continues to drop. We saw it again. We're going to continue to see savings come down. It's back to 2000, the levels that we saw in 2013. And we think it is going to continue to worsen in general because people are using credit. So credit card spending, retail and food service, you can see the 4-week moving average continues to be elevated because people are using more and more credit. And we saw credit come down. There was a huge drop off. We have a chart on that will show. And now you're seeing it get added back very quickly, which is why when you look at the consumer confidence index, remember the people in the highest brackets account for the most spending in the US. But yet when you look at the consumer confidence indicator by income group, the people that are in that bracket are seeing the biggest drop off. And that's the concern, because those are the people that are driving the driving force. So as they get more concerned, they pull back. Those are the ones that are going out to eat once or twice a week. Those are the ones that are ordering takeout more often. If they see a shirt they like, they're more likely to buy impulse. And if that goes away, which it has quickly, that's where we start to see some of these pressure points. And the reason is because when you look at every segment in the PCE categories, prices are up, even if demand isn't up. So that just means that if even demand isn't the driver for some of this, it's actually the supply side. And as we know, the supply side is getting worse again because of Chinese lockdowns, because of COVID supply chain bottlenecks, which are just coming back to rear its ugly head. So as JP Morgan says, even in many areas where demand is running below the pre-pandemic trend, prices have moved above their pre-pandemic trends. Inflation pressures have been building lately, even without relatively firming in demand, which again, creating some of these underlying problems, which is why companies are starting to mention weak demand this quarter. So when you're looking at the more and more mentions of weak demand, we're coming back to, obviously at pre-COVID, COVID, but we're coming into those 2011, 2012 levels, which is, I think, the bigger concern that we're going to see. And I expect to see that demand become more consistent, or demand concerns, especially given what the Small Business Bureau put out on their most recent data sets. So in the meantime, a third of businesses report diversifying suppliers across geographic regions, and that's only going to be reinforced with the issues that we're seeing right now in China. But it's not free. You have to spend money because you have to build. Do you have a warehouse? Can you rent warehouse space? Do you have a slip? Do you need a slip? Docking area. Like, these are things that are going to become more expensive, but in the long term, will help diversify and create some protection. So while all of this is happening, you continue to have the cumulative central bank balance sheets coming off, and it's not so much because they're actively selling. Some of them are, don't get me wrong, but it's just they're not buying anymore. So as things mature, because they were buying short duration, long duration, short duration, you have things expire or mature every day, every week, depending on when it was bought. So again, that's going to naturally bring down balance sheets, but it's not at the same pace or the pace that they want. So just to think about what the U.S. is doing and what the Fed had said. So the committee intends to reduce the Federal Reserve securities holdings over time in a predictable manner, beginning on June 1st. So beginning on June 1st. So we're still in May. So they still haven't actively sold. Principal payments from securities held in the system open market account will be reinvested to the extent that they exceed monthly caps. For Treasury securities, the cap will be set at $30 billion per month, and after 3 months will increase to $60 billion per month. The decline in holdings of Treasury securities under this monthly cap will include Treasury coupon securities. So you're going to see them actively selling. For agency debt and agency mortgage-backed securities, the cap will initially be set at $17.5 billion per month, and after 3 months, increase to $35 billion per month. So again, that's how quickly they're going to look to actively sell, not just let it expire, but actively sell it into the market. The committee intends to maintain securities holdings in amounts needed to implement monetary policy efficiently to ensure a smooth transition. The committee intends to slow and then stop the decline in the size of the balance sheet when reserve balances are somewhat above the level it judges to be consistent with ample reserves, which if we go back to where they were, just looking at the chart that we have, if you look at back to where we were on, let's call it, right now we're at about 34%, 37% of GDP. They've talked about getting to just below 20%, and that's something that's going to take time to get to, and you don't want to do it all at once, or otherwise you're going to just blow up the market. But again, you're going to see this accelerate, and they're going to go from active buyers to neutral to active sellers, and we have yet to really see that because it starts in earnest in June. And this is why when we start looking at defensives, when we start looking at different ratios, we expect to see this underlying drawdown and this pressure continue to mount within the U.S. and on rates in general, which is why the pile of troubled debt in Americas swells to a one-year high, because people are looking at this and they're reassessing debt. They're reassessing risk, where they're looking at this and saying, okay, well, when the Fed was bringing things down, I would buy that triple B at 7%. But now that things are getting a bit riskier, 7% is just not right. Like, I'm going to need 11%, maybe 12%. But how does the company pay for that? And that's where you're seeing more and more pressure get weighted on. And that's when these companies are looking at this, especially the zombies, which rely on cheap debt to continue to operate. Where do they function? How do they continue to grow? And the pressure that continues to move through the system. And that's why when we look at the U.S. inflation map and you look at the pressure not only on the corporate level, but then the consumer, you can see that the pace of consumer prices is a bit slower on the coast. But remember, they were already expensive on the coast. So the rate of change is going to be harder because you're starting from a higher number. But you could see it's a national problem, and the places that had lower cost of living are seeing an exponential jump, which is only getting worse just given because, again, it costs money to get things from California and the ports to Utah, Colorado, Wyoming. And if you look at diesel prices, diesel availability, that's where we continue to see a lot of that pressure. And that pressure is showing up in U.S. consumer credit. So this was the second month in a row that we had a record amount of new credit put on. The expectation was for $25 billion. We hit $52.4 billion. And now when you look at the revolving consumer credit, which is just how much credit does the consumer have, we are back to pre-COVID levels. So every benefit where every person that paid off their credit card, paid off their credit, paid off their equity lines. That is now completely reversed, and you could see the rate of change accelerated at the back half of last year and has only continued to go up. Again, showing just the stress that consumers are under, which is why when you look at household savings and checking balances for a fixed cohort of savers as of 2019, it's a bit of a mismatch, because when you look at all households, you can see all households is very much skewed by the top. And then you look at households with an income lower, you can see that they still have a higher savings, but this was struck as of January 2022. That is now all gone. And that's why as that deviated, because you had people that were like, well, I'll pull a little bit out of savings, I'll put a little extra on the card. Now as savings go down, everything goes on the card. And that's why we've seen this huge spike in credit. So then when you look at the PPI side, April PPI came in at 11% versus 10.7% estimates. So again, it's still coming in above estimates. Yes, it paused. We did have a pause in new pricing, and it came down from 11.5% to 11%. So we had an adjustment of 0.5. It month on month came in line. Core came in right in line with at about 8.8%. The expectation was 8.9%. So you're getting some of this pause. But that's because we had supply chains catching up. You had demand slowing a bit. You had some things starting to catch up. You had wages you had wages that had gone up, but then you started to see that kind of flat line at about that level. But now you have employment costs going back up. You have diesel at record prices. You have gasoline at record prices. Then you have the shortages on the supply side, and you have demand where consumers are trying to maintain their consumption at the same patterns. That will slow, but the supply hit is going to make this, and as we said before, it's going to make it worse, but our assumption is that we just hold the top. We don't continue to get these big shifts higher, but we just bump along sideways, which is where we come up with that pivot from inflation into stagflation. And that's where we think a lot of the market is wrong, because they're expecting this steeper drop off. And has inflation peaked? Not quite yet. For those that have been following us for over, as long as we've been doing this, we've been very clear that we expect inflation to continue to go up through June, but then it's going to peak, and you're going to have that stagflation really sit in. And here's where it starts, because now as PPI flatlines a bit, you'll try to push through whatever's left or whatever you can on pricing down to the consumer. It won't be one-to-one. And that's where you're going to try to see that management. But this still doesn't cover the issues with China and the supply chain, which we do think gets one more push. And then we'll see a lot of that flat line. And the contribution to April PPI was goods, less food, and energy. Again, things that are much stickier. But also energy went down in April, and now it's going to come back up in May, which again is going to push that back to the highs. And why we think we have a lot of those tailwinds to keep us at those highs, which is something we're also seeing at the small business side. The single most important problem for a small business is inflation. Now, when you look at quality of labor, that's still front and center. So they're still struggling to find quality labor, but inflation is now becoming more readily apparent, more of a problem. And how are they going to pass that on? And that's where they continue to see that pressure, which is why when you look at business optimism in line with expectations at 93.2 versus last month at 92.9, but the outlook continues to get worse, as a net of 50% of firms expect better economy, 20% anticipate job creation, those with jobs not able to fill unchanged at 47%. So when you look at general business conditions, it's at negative 50%. So negative 50%. So there are a significant amount of people that think things are going to get much worse over that time period, which means that if you think that your business is going to get worse, are you going to invest? Are you going to hire? Are you going to build inventory? You're going to just cut back in general, and you can see that this is the worst it's been going back really through 2004. This is even worse than the beginning of COVID. Again, why a lot of these problems are persistent. Now, this is going to be something important to watch because there's more down from the peak of hard to fill. You can see it's coming off the peak, still near all-time highs, still elevated. Hiring plans have come down, still going back to the 70s. It's still elevated, so they're still looking to hire, but you're seeing that slowdown. You're seeing those pressures because, again, where are wages going? And that's when we look at higher prices. So a slight downtick in number of small businesses reporting higher prices because the difficulty of pushing it through. But again, you're still at over 70% reporting higher prices, just down a touch. Slight uptick in companies reporting poor sales as an important problem. Again, it's a slight uptick, but as you get prices coming up, then you have consumers walking in going, I can't afford that. Like I can't buy that right now. And then they walk right back out. And that's where we start to see this come up. And this could be the start of something or just a little blip, but that sales piece is going to be the important one to watch. Then when you look at the composite index, so solid chunk of small businesses continue to raise compensation and maintain plans to do so per the April because we're still in a tight labor market, which is if you're in a tight labor market, you have to increase wages. If you increase wages, you have to try to increase prices. And again, that's why we see this as more pressure and more of that slowdown coming. All the while, U.S. core services CPI month over month came in at 0.7%. Rent of primary residences continue to be at near all-time highs as that needs to catch up. So you have CPI moving on a lot of these key levels as they try to push down those additional prices, especially on the services front. Then when you look at owner's equivalent rent portion of CPI continued its climb. It's up 4.8% year over year in April. And if you look at the consumer, if you're looking at your rent going up, and especially if you're rolling, if you're looking to move, you're going to be spending less. Now, as this all happens, the in-person activity is still remaining significantly off normal paces when you're looking at people going into the office. So as you go into the office less, you're going to want to stay at home more. You'll want to have a nicer place. And that's, again, creating also some of this additional pressure to the upside. But when you look at rents right now, the rents keep rising. So the model, we still have almost 7%, and yet we have the CPI at 4.8%. So again, you're going to have that stickiness, which is what we've been talking about on sticky versus flexible. Sticky is going to continue to be that driver, that pressure point moving higher, keeping CPI moving in the wrong direction. And then when you look at year-over-year home appreciation, the HPA will continue to be in the mid-teens through June. And then the unprecedented surge in home buyer mortgage payments has gone parabolic from just below $1,750 to about $2,400. And again, this is where we see that big slowdown in just what people can afford and spend, which is what we think is going to show up in U.S. retail and recreation mobility as people do a bit less. And you start to see this flatline a bit with some of these different pressure points as we go into, I think, some of those key months, because typically we get a surge on a seasonal basis. So I think it's important to look at seasonality because we should be going higher. But do we go back to the peak, or do we have a fairly steep drop off just because of the inability to spend and because of just how high inflation remains and stays that underlying problem for people spending and how they can spend in general. Now, in the next segment, we're going to look at jobs a bit deeper and underlying prices and how that's going to impact the consumer in a much bigger way.